Morning. Are we there? Yeah, yeah, good morning now.
Yeah, good morning.
Yes. Well, we are welcome to another class today. Please let us inform the other that the class have started so that they can join. So we are still going to continue with, in our last class, we treated question on loss relief. So we are still going to continue with that. So where we did a question on carry forward. So we also need to look at when we have a situation of current year loss relief. So how do we what? How do we go about that when there is what? When there is current year loss relief. So still on that material for loss relief, I have shared the material. So we are still going to, I think we treated question number 1, Abby. Hello? We treated question number 1, if I'm right. Hello? Can somebody attest to me? We treated question number 1.
Yes,
Is
sir,
that
we
right?
did.
Yes. I just want to confirm. Just want to be sure that we are on the same page. So we are going to deal with question number 3 today. Question number 3 on page 5. Question number 3, page 5. So let me look for an Excel sheet that we are going to use. Question number 3, page 5. So we have dealt with the current year carry forward. We also need to look at where we have a situation of current year loss relief. So how do we tackle that for current year loss relief? Just give me some minutes. Yes. Yes. So the question goes further. Mr. Gunners provide you with the following information in relation to his income. We have trade and rent. Adjusted profit or income, we have from trade and from rent. Shit. Okay. Year ended 31/3/2020. Year ended 30/3/2021. Year ended 30/3/2022. Year ended 30/3/2023. Year ended 30/3/2024. All are figures. So my question now is this, that they now say, note, capital allowance claiming for 2025 year of assessment amounted to 60,000 because I showed the loss available for relief for the relevant year of assessment if he took advantage of his rental income. For a question like this, how do I know as a student that this question is on current year loss relief? The first thing that will guide you is that the taxpayer is an individual. And for individual taxpayer, they can either go for the current year or carry forward loss relief. Then being an individual taxpayer, the next thing is that he has more than one sources of income. He has income from trade and he also has income from rent. So being a taxpayer, being an individual and having various sources of income, he has a right to opt for the current year loss relief, which is available for him. So in adopting the current year, so how do we do that? So we have the question Mr. Gunnar provide you with the following form. So as we know that tax is payable on preceding year basis. So the tax liability for the year ended 31/3/2020. So it's going to pay the tax in 2021 year of assessment. But one characteristic of current year loss relief is that the relief is available on actual year basis. That is one characteristic. Then he also has a right to relieve the loss from all sources of income in the first year, in which after the first year, he can only relieve it from the same source after the first year. Then he's having what? Only maximum period of 4 times to relieve what? To relieve losses under what? Under the what? The current year loss relief. So because of that, so let us look at, so we have the name of, so let us make use of our Excel sheet to make it easier for us. Coming.
Good morning, sir.
Morning.
Yes, sir. Please, I would want to ask for a favor. Please,
Okay.
can you make the font size really big, like bigger? Most times, like some of the recorded messages, the spread Excel sheet, the information, they are not even clear, and the fonts they are so tiny. The size they're so tiny.
Okay.
Have it really visible.
Okay.
Thank you,
All
sir.
right. No problem. Okay. I want to check something. Coming. Okay. Yes. So somebody requested that. So let me increase the font so that, so we have the name of the company, the name of the taxpayer, which an individual, Mr. Gunners. Is the, so we have what? Computation of total income. Computation of total income for relevant year of assessment. Computation of total income for relevant year of assessment. So tax, as I told us, will be paid on what? On preceding year basis. So the income for the year ended 31/3/2020, the tax will be payable in 2021. So the first tax year we are going to have will be 2021 year of assessment. So we have the first tax year, which is 2021. So in 2021, as we can see, we have, in 2021 year of assessment, we are going to have income from trade and income from rent. So we are going to state those two income. So we are going to state rental, trade, we have income from trade. Then we also have income from rent. So we have those two categories of income. Income from trade, we have 25,000. Income from rent, we have 50,000. So I have it as 25,000 and 50,000. In which, I hope it's visible now. Can you see it clearly now?
Yes, sir.
Hello?
Thank you. Yes, sir.
Okay.
Thank
Yeah. So these are the two income for the 2021 year of assessment. So its total income will be 75,000. Its total income will be 75,000. On this income now, so don't forget we are using current year loss relief. On this income now, so let us go back to our question. On this income, we have what? Year ended 30/3/2021. We have a loss in 2021 period of 200,000 from trade. And don't forget, under current year, I told you that the loss will be available on what? Actual year basis. So that means this loss is going to come in what? 2021 year of assessment. Loss of what? 200,000 naira. So we are going to consider that loss in that year, loss of 200,000 naira. So you now come to our computation. So we have what? Current year loss. So that loss is from where? Trade. 200,000 naira. Out of this 200,000 naira that is coming, we have to relieve, loss relief. We are told that you have a right to relieve all your losses from all sources of income in the first year. So that means in this first year now, this man, how much is his total income in 2021? Oh yeah, I'm listening. How much is total income in 2021? How much is his total income in 2021 year of assessment? 75,000. So he has a right to relieve all this loss. So loss relief now. So this will be in jacket. It's a loss. $200,000. Yeah. So loss relief now will now give us 75,000. It's going to remove the 75,000 from that. It will also remove the 75,000 naira from this. We'll transfer it to here and remove from here to get what? So, but the amount you want to relieve is 200,000. You can only relieve 75,000. So the balance will be carried forward. Loss carried forward, which is 200 minus 75,000. That will give us how much? Oh yeah, 200 minus 75,000.
125,000.
125,000 loss. So his loss will be 125,000. The loss that will be carried forward will be 125,000. So it's taxable, chargeable, dischargeable income now will now be nil. Because why? Because he has what? Exhausted his income. By what? By relieving that income from where? From the loss he made. So that means he's not going to be liable to any tax. The question did not ask us for tax liability. Assuming the question asks you for tax liability, you will now what? Apply the various tax rates. For individual, we have what? The graduated tax rate, which is what? The first 300,000 and so on and so forth. We are not requested for that, so we are going to what? So his chargeable income will be what? Will be nil. So it's not going to what? Have any chargeable income in this what? This 2021 year of assessment. After 2021, we have the next year, which is 2022. In 2022 year of assessment, what happened? Let's go to our question again. What happened in 2022? In 2022, we have what? Year ended 30/3/2021. There is a loss that we have considered. We only have what? Income from what? Rent. We only have rental income left now. So you now bring what? You bring what? Income from rent. How much? 50,000. So we have what? Loss brought forward. How much? 125,000. We have a loss of 125,000 that we are bringing from 2021. Out of this loss is from this loss brought forward. Loss brought forward. So you have to be very careful. It's from trade. So, and after the first year, you can only relieve it from where? From only that source where that loss is being what? Generated from. No income from trade in 2022. So that means loss relief. Nothing will be relieved. So this entire amount will be what? Will be loss carried forward. Will be carried forward to the next period as what? As the same 125,000. So chargeable income now. Chargeable income will now give us what? 50,000 naira. Because what? It does not have what? A profit to relieve what? To relieve that loss. In what? In that year 2022. After year 2022, we move to the next year, which is what? 2023. In 2023 year of assessment, what do we have in 2023? So let us go to our question, make it easier for us. So in 2023, which is for year ended 30/3/2022, we have income from trade and from rent, 10,000 and 50,000. Trade income, 10,000 naira. We also have rental income of 50,000 naira. His total income here. Total income will give us 50 plus 10. That is what? 60,000 naira. Out of this, so we have what? Loss brought forward, which is from where? From trade.
No,
Okay, you are okay. Yeah, sir. Okay.
yes.
Sorry. Okay. Okay. 2023. We have the trade income 10,000. We have the rental income 50,000. Total income will give us 50,000 plus 10. That is what? 60,000. Which is this 60,000. We have a loss brought forward. Loss brought forward from trade, which is how much? 125,000. Loss of 125,000. This loss now can only be relieved. Loss relief. It can only be relieved from that trade income. And in this 2023, we only the taxpayer only made how much from trade income? 10,000 naira. You can only what? Claim 10,000. Because it is only in the first year that you can claim for all the sources. After the first year, you can only claim from where? From only the source where the loss is being generated from. So loss relief, we are going to claim the 10,000 from here. So loss carried forward will give us 125,000 minus 10,000. That will give us how much? 115. So taxable income, chargeable income, will give us 60,000 minus 10,000. That will give us how much? 50,000. Which is what? Which is the loss for that year. After 2023, we move to the next year, which is what? 2024. In 2024, we also need to look at what happened. Go back to our question. 2024, which is for the year ended 33/2023. 33/2023. 33/2023. 33. We have what? Income from trade 20,000 and income from rent 50,000. Yeah. Income from trade income, and rental income. Income from trade, we have it as 20,000 and 50,000. So we have what? 20,000, 50,000. Is total income will give us 20 plus 50. That is what? 70,000. From this, we have what? Loss brought forward, which is from trading
You
activity.
can't see your Excel sheet, sir.
Trade income 20,000, rental income 50,000. The total will be 50 plus 20. That is 70,000. Loss brought forward, we have what? We are still left with what? Loss of 115,000. This 115 can only be relieved from this same source of income of trade. And how much did we make from trade in 2024? How much did the taxpayer make from trade in 2024? You can tell me.
20,000.
20,000. Only 20,000. 20,000. So loss relief. So you can only relieve loss relief. You can only relieve loss relief. We can only relieve 20,000. So the 20,000 will also be relieved from his income. So we now have loss. So what will now happen to this loss now? We now go back to our we are from, I told us earlier that what an individual has only how many times to relieve his loss? Who can remind us? Individual has only how many? Yes, 4 times. So this is what the first, number 1, 2, in 2022, 2, 2023, 3, 2024, 4. After the 4th time, any balance will become what? Become lapse. So the implication of that is that what this loss of 115 minus 20,000, which is how much is that? 115 minus 20,000, how much?
95.
95,000. This loss of 95,000 cannot be taken to the next period. This loss will become what? It will now become loss lapse. Why? Because we only asked what? 4 times to relieve the loss. After the 4th time, that loss cannot be what? Cannot be recovered again. And don't say, okay, because if you look at it, you can look at it and say, but in 2022, it did not what? It did not relieve, is unable to relieve. It has to follow that order 4 times. The fact that it did not relieve himself, the Lord did not ask him not to make income in that 2022 year of assessment. And also, before we proceed further, before we can do that, I'm also seeing something in line with in that 2024. In that 2024, there is something. So before we go to that loss relief, we have a loss brought forward, which is 114. We also have in 2024, let me share this. If you look at 2024, year ended 33, in year 2024, there is also a loss from where? From rent of how much? 20,000. Look at it. Loss of in year 2024. This is the year 2024, actual year. There is a loss from rent of 20,000. That loss has to be taken into consideration also in this year 2024. So you now, after your loss brought forward, you also have current year loss. That current year loss is from which source of income? Rent. How much is that? How much is that current year loss from rent in 2024? Oh yeah, now let somebody respond. How much is that current year loss in year 2024? Current 20,000 naira is 20,000 naira. The current year loss is 20,000 naira. 20,000 naira. So we are also going to consider it here, 20,000 naira. So the addition of these two now will now give us total. Will now give us total loss. The total loss will now be 115 plus 20,000. That will give us how much? 115 plus 20,000.
135,000.
135,000. Yes, out of this 35,000 now, loss relief. So let us now see. How much can we relieve? We can only relieve from the trade. You can only relieve 20,000 from trade. Then from this current year of rent, there's also a loss of 20,000. We also relieve 20,000 from rental income because it's from that source. So that means in total, the total loss we are going to relieve will be what? 20,000 plus 20,000. That will give us how much?
40,000.
40,000. We can relieve what? The loss of what? 40,000 from where? From that's what? That so loss relief will be what? 40,000 naira. So which we are going to transfer to this column, 40,000. So loss carry for so because loss, look at it now. Loss labs. Loss labs now will now be 135,000 minus 40,000. How much? Oh yeah, now 135,000 minus 40,000.
5,000.
Eh?
95,000.
95,000. So this 95,000 naira loss now cannot be taken to what? To the next period. Why? Because that loss is from trade. And he only has 4 times to what? To relieve that loss. And he has started from 2021. We have 1, 2022, 2, 2023, 3, and 2024, 4. After 2024, any balance will become lapse, cannot be taken to what? To next period. So it's chargeable income now. Chargeable income will now be 70,000 minus 40,000. That will give us how much?
30,000.
70,000. So it will give us what? 30,000. So chargeable income will be what? 30,000 naira. So which is what? Which is that? Then after year 2024, the next year, which is will be what? 2025 year of assessment. So what will happen in 2025 year of assessment? Let us go back to our question. In 2025, what happened? Let me share the question. In 2025, what is going? So in 2025, we are going to have what? Only income from where? From trade of 80,000. Income from trade, 80,000. So we have what? Trade income from trade. So we have it as trade income. Trade income. How much is that? How much is the trade income? 80,000. 80 trade income, 80,000. We have what? 80,000 naira. Out of this trade income, we are told we cannot bring any loss, no loss brought forward. Why? Because this 95,000 has become what? Lapse. The only loss that can be brought forward here is assuming we still have loss from where? From rent. But all the loss generated from rent has been what? Has been relieved in what? In 2024 year of assessment. So nothing can be brought forward in 2025 year of assessment. So because nothing can be brought forward, so we don't have any what? So we don't have any loss brought forward. So in that case, so we have what? We are going to have, so only the law. But in that same 2025, we are told we have an information. So let me go back to the question. So we have an information stated by the examiner that, note, capital allowance claimable for 2025 year of assessment amounted to 60,000. Capital allowance amounted to 60,000. Since there is no loss, we now what? We are going to consider the capital allowance. So you now bring it, capital allowance for the year. 60,000. Out of this capital allowance, we are expected to relieve this what? This capital allowance. And now to my question. Capital allowance is usually restricted to what percentage? Who can remind us? Capital allowance is restricted to what percentage? Yeah, I'm expecting our reply. Capital allowance is, yeah?
66%.
66 what?
Percent.
No, it's not only 66%. It's 66 something. It's restricted to 66 something percent. Yeah? It's restricted to what? 66 to 3% of accessible profit. 66 to 3% of accessible profit. Except where the company is a what? Manufacturing and what? Agro-allied. And in this question, we are not told of the nature of the company. That means we assume the company is what? Is trading. So we are going to restrict what? To what? 2/3. Just simply say 2/3 of accessible profit. 2/3 of our accessible profit. So our accessible profit is the 80,000 we have here from trading income. So if you learn 2/3 of 80,000, how much did it give us? 2/3 of 80,000. Oh yeah, now somebody should press calculator. 2/3 of 80,000. How much do we have?
53.33.
So we have so we are going to, so that means we can only remove 53,333. So the balance will be what? Will be taken to what? To next period. So we have a 53,333. So the balance will be what? Capital allowance carried forward. We are going to carry the balance to the next period, which is what? Capital allowance carried forward of how much? 60,000 minus 53,333. That will give us how much? 60,000 minus 53,333. That is how much?
54667.
54. Are you sure?
6,667.
6,667. So which is what?
Sorry.
Which is the capital allowance that we are going to carry to next period. After carrying the capital allowance, so we have what? We have the balance of our. So we now have what? Chargeable income. We be what? 80,000 minus 53,333. 80,000 minus 53,333. How much do we have?
26,667.
Yeah?
26,667.
26,667. So that will be what? That will be our what? Our chargeable income. So after that, so we can now go to, we now proceed further. Let's go back to our question. So let me go back to the question. So the question stop at what? 33/2024, which is 2025 year of assessment. So that means that we don't have any other information. So that is the only information that what the question can accommodate. So that will be what? That will be the solution as far as what? As far as this one, this particular question is concerned. So this one is what? When you are adopting what? The current year loss relief. So the relief will be what? Will be what? On actual year basis. Note that actual year basis. It is that year that the loss occur. That's what the taxpayer is going to what? Has a right to what? To start claiming the what? The loss. Please, let us take note of that. Current year loss relief. So that's what they mean by what? So it is on what? Actual year basis. So that year that it occur, you can start claiming the loss from that year that the loss occur. So, but unlike the second one, which is what? In the case of what? Carry forward, which is what? On preceding year basis. But this one is on what? Actual year basis. So let us take note of that. So what? And so let us take, so that is the solution. So for what? For the question, as far as what that question is what is concerned, so which is what? Which is the question forward for that particular aspect. So we also have the solution here. So I will implore us to also go over it and what? Also look at it for our own or for our own. So any question? So I'm going to send the Excel solution to us. So at the completion of the class. So yes. So that is what that is the solution for that. So any question? Any question? Any question? So in the absence of no question, so we have successfully dealt with what? A question on both current year and what? And carry forward. We also have a question in that material, question number 2. So we can as well look at it at our lecture time. The question number 2, focus on what? Is also what? The solution is also there. That is also on what? That one is on carry forward loss relief is a company. So please let us what? Let us go over what and what and master the question. So in the absence of no question, so we have successfully completed what? Loss relief. So we have successfully completed loss relief. So which is what? Where you are looking at either what? The carry forward or current year loss relief. So, and the current year, don't forget, is only applicable to what? To individual and what? To be adopted where the individual has what? Has various sources of income. So please let us what? Let us also what? Familiarize ourselves with what? With those information. So as a result of that, we'll be moving to another topic as well. So which is what? Which is on, so we'll be moving to withholding tax. So that is our new topic, the new topic that we're going to be moving to, withholding tax. So withholding tax. So withholding tax. So we have what? So nature of withholding tax. So this withholding tax now, so what do we mean by withholding tax? We have various types of taxes. We have what? Which are categorized into two forms. We have what? Direct and indirect. Part of the direct tax, we have a personal income tax, we have the company income tax, we have what? The petroleum industry act. So we have what? Other form of taxes that are what? That are direct. We also have those that are what? Indirect, such as what? Our value added tax, our what? Our custom and excise duty, our consumption tax, and so on and so forth. In all these taxes, this withholding tax is not another form of tax. It is just what? An advance payment of tax. It is an advance payment of tax that is what? Deducted at source from payments made or received from a third party, which is going to be available as a set-off against subsequent tax liability. So withholding tax is not another form of tax like what? Like personal income tax, company income tax, or the other form of tax. It is what? An advance payment of tax. It is the tax you are supposed to pay, but they want to collect it in advance. So why did government decide that they want to collect it in advance? Very simple. The reason being that if the government does not collect the tax on this particular income in advance, majority of the taxpayer will end up not paying tax on those income. For instance, you and I that we are working, we are in paid employment. So as we are in paid employment, assuming you are financial, so I want to ask us this question now, which I want us to reply with what? Utmost good faith in. So assuming as you are working with your employer, in which what? Before your employer will pay you your salary, your employer will deduct what is called what? What is called payee from your salary and remit to relevant tax authority. Maybe you are now financially blessed, you have money. So because you have excess money, you decide to invest that money in what? In deposit, fixed deposit, or you leave it in bank for the purpose of what? Interest. By the time the bank pay us interest, pay you the interest, do you think you are going to declare that income to your employer? I'm asking us the question. Do we think we are going to declare that income to our employer by the time our bank pay us that interest? Are we going to declare the income to our employer? I'm expecting our reply. Assuming you are working
question. Sorry, sir. Come again with the question.
Okay, my question is, you are working as an employee in a company, which they deduct your pay from your salary. But you also have another source of income. You invested in bank, and the bank pays you interest. If the bank pay you that interest, are you going to declare that interest to your employer as additional source of income?
No, sir.
No, no single taxpayer will be willing to what? To disclose that information. So because of that, that is the reason why our government came up with what? With this withholding tax regulation. So which was that it is part of the tax you are supposed to pay, but they are going to collect it in what? In advance. To be collected in advance from your work. So when they are going to pay you that. Sorry, the network went off. The new regulation, which is what? The withholding tax regulation, which came up effective from January 2025, is what you are expected to note as what, as far as what the withholding tax is concerned, which is what we are going to consider in our what under this material. So this withholding tax regulation now has the following. So that is what all about withholding tax. And what are the features of this withholding tax? Features of withholding tax. So features of withholding tax. Features of withholding tax. Features of withholding tax. Withholding tax, payment of withholding tax is statutory on the person making the payment. It is not by ignorance of the law, it's not an excuse. Once you are an agent for deduction, it is mandated on you to deduct. Failure to deduct, you are going to what? You are going to suffer what? The consequence. So it is what? Compulsory on you to deduct what? The withholding tax. The withholding tax credit is usually used to offset tax liability. Any amount you suffer in advance is not a waste. You are going to use it to what? To reduce your tax liability. There is an advance payment of income tax, so it is collected in advance against what? Again, on frank investment income. There are some income that are regarded as what? Frank investment income. Example of such income is what? Is dividend. Dividend. So that income, any withholding tax you suffered on it is final. It's not going to be available as a set-off against what? Against further tax liability. So any withholding tax suffered on what? On that income is regarded as what? Frank investment income. It's final. So that is what for the withholding tax.
Sir, please, why? Why is that so, sir?
Okay, because those category of income, they are regarded as what? They look at it as most of those income, it makes it difficult. The beneficiary of those income are individual. Dividend. For you to be a director of a company, you must be what? An individual. Under that income, under that category of income, the rate is applicable to only individual. Because for you to be a director of a company, director cannot be what? It cannot be somebody that's not in the system. It must be what? You must be an individual. And most of these individuals, most of them, not all individuals are what? Are in business. Are what? They are in business. They are running business. So those that are not running business, they don't keep record of this transaction like you and I. So if you don't keep record of this transaction, if they now pay you this dividend, you will end up not what? Not disclosing that or that income. And there is no way government can trace that or that income. That's the reason why what government decided that any income you receive from where? From that dividend is what? Any tax you pay on it is final, because you are not going to end up with declaring that income again. So I hope that settles your question. So that is why it is regarded as a frank investment income. Then what are the types of what? Withholding tax. As far as withholding tax, there are two types of withholding tax. We have a withholding tax payable and withholding tax claimable. So those are the two types: withholding tax payable and withholding tax claimable. So payable and claimable or recoupable. So what is withholding tax payable? The withholding tax payable is the withholding tax suffered from payment made to a third party, which will be what? Remitted to what? To the relevant tax authority for the purpose of what? Of relief. So is the withholding tax deducted from payment made to a third party, which will be remitted to the relevant tax authority for the purpose of relief by the what? By the third party. For instance, let's say we have equity professional as an accounting firm, an accounting consulting company that is providing what? Accounting and what? And taxation what? Taxation services. So they provide lecture. Maybe part of for those students who are what? Who are the physical students. Those students, they have a classroom where they make use of. They also have, in those classrooms, there are facility, there are fan, there are tables and chairs and other facilities that are available. It is possible for those facilities to be faulty. An equity professional does not, for instance, assuming one of the ceiling fan is faulty. That is not the work of equity professional. For them to get that fan fixed, they need to engage the service of what? Of a fan repairer. So to engage the service of that fan repairer, they need to pay that person certain amount, the contract amount. So before they pay that person that contract amount, it is expected that they must deduct what is called withholding tax before they pay him that contract amount. That withholding tax deducted by equity professional from that payment you are going to pay. For instance, assuming that person that want to do that particular service, I want to enter that service, let's say Mr. Kunle, the withholding tax they are going to deduct from that Kunle, from his income, is what is called withholding tax payable to what? To equity professional. So that withholding tax payable is not the money of equity professional. They have a time limit to remit it to the relevant tax authority. They must remit it to the relevant tax authority on or before the due date, which we are going to still talk about. And remitting it to the relevant tax authority. So once they remit it, that means what? Kunle, the person who suffered that withholding tax will be able to use it to reduce his tax liability. And this amount is expected to be to be remitted on or before the due date. And every company also will prepare their account at the end of their accounting date. Where at the end of accounting date, this amount is yet to be remitted. It must be accounted for, because it is not the company money. It is what? It is money they are owing. It is based to them. So they must account for it. In accounting for it, they are going to put it in what? In their statement of financial position as a current liability. So that's why you see, for those of us that work in audit firm, in some of when you are preparing your account, you will see there that you have a current liability, you will see withholding tax payable. Because it is yet to be remitted. That is why it is stated as a current liability in the company's. So that is for withholding tax payable. Then we also have withholding tax claimable. withholding tax claimable. That is the withholding tax suffered from where? From payment received from third party, which should be what? Available as a set-off by the taxpayer. From payment received. So when you are receiving payment now, the one you suffer from payment you receive from a third party is now regarded as well withholding tax claimable or recoupable. So you are not, you as a taxpayer, you are not going to use it to what? To reduce your tax liability. Also, for instance, the issue of what? Equity professional, example of equity professional that I gave earlier. For instance, equity professional now, an accounting firm. So maybe a company now engage their service, another firm, let's say XYZ Limited, engage the service of equity professional to come and tutor their staff, their accounting department on what? On ICAN, on how to what? How to pass ICAN and what? On ICAN lecture generally. So they engage their staff. That means money is going to come from where? XYZ Limited to what? Equity professional. It is also mandated on XYZ before they pay equity professional to also deduct from the money from the contract sum. Any money that is being suffered by what? By equity professional from the money they are receiving from XYZ Limited is called withholding tax claiming. So that means for a company can have both what? Withholding tax payable, tax claimable. So let us take note of that. And it is also at the end of the year where they are yet to claim it, where they are yet to use it, where they are yet to use it to reduce their tax liability. It must also be accounted for in their books. So where they are yet to use it to reduce their tax liability, they will state it as what? As a current asset in their what? In their statement of financial position. It will be stated as a current asset in their statement of financial, where they are yet to use it to reduce their tax liability. And one peculiar, so I'm coming, wait, one peculiarity about this is that a company can have both withholding tax payable and claimable. Oh yeah, what's your question? Then, so as I was saying, okay, somebody wanted to ask me a question before the something went off.
Sir, I was saying
Question
that
now.
I got locked out, like I couldn't view the screen. So the information about the withholding tax and the types, I lost out.
Do what?
He's saying that she missed out on the types of withholding tax. We pay.
Okay. Yes. We have two types. As I was saying, we have payable, withholding tax payable, and claimable. Payable is what? Any withholding tax you deduct when you are making payment as an agent. While the claimable is what? Any withholding tax you saw from another person. So that is just the difference between what? The withholding tax payable and claimable. And as I was saying, the two withholding tax, they are separate items of against one another. You cannot say, okay, because I want and I want to claim 100,000. Let me remove the 100,000 from the 200,000 and pay the balance of what 100,000. It is not allowed. Where you want to pay what is due and claim what is due. It is only under VAT that you can remove your input VAT from your output VAT. So please, for withholding tax, your withholding tax payable from your withholding tax claimable. So is that clear? So let us take note of that. So they are to be
State that
treated.
line again. Sorry, sir. State the line again.
So what I'm saying is that the two items cannot be set off against one another. They are separate items. When you have withholding tax payable of 10,000 and you have what? Withholding tax, you have claimable of 10,000 and you have payable of 20,000. You cannot remove the 10,000 from 20,000. You have to pay what is due and claim what is due. So they are to be treated separately. That is the reason why if you are yet to pay any amount as your balance sheet day, it will be recorded as well. Current liability. If you are here to claim, it will be recorded as what? As current asset. So let us take note of that. So that is for what? for the withholding tax. Then the tax law has also made it mandatory that what, where a withholding tax amount has been, for instance, maybe somebody has suffered a withholding tax and that person does not have anywhere to claim that withholding tax. No, maybe as a result of what? Maybe that particular taxpayer is being exempted from tax, or because of other activity, or they want to cease operation, and they have a withholding tax refund to claim. It is expected that that refund must be refunded back to the taxpayer within 90 days. Once it has been established that there is going to be a refund. But where you are still going to be in business, you are going to use it to claim your subsequent tax liability. But where you are going to stop business and you have a refund, or where you are not liable to tax as a result of your nature of your activity, so you are going to be what? You are going to get a refund of what? Of the withholding tax within 90 days of what? Of application once it has been established. So if I have deducted, assuming I am an agent now, I have deducted withholding tax, and we have various tax authorities. We have the state internal revenue, we have the federal inland revenue, we have the local government revenue committee, we have the joint tax board. How do I know where to remit withholding tax to, according to law? So for any payment that I deduct from companies, where the recipient of that payment is a company, the withholding tax is remitted to federal inland revenue. Any withholding tax deducted from payment made to company due to company is payable to federal inland revenue service. The withholding tax from payment due to individual, for the one due to individual, enterprise, partners in a partnership business, unincorporated company, trustee in a trust and settlement, community, are remitted to a state internal revenue service of their resident. State internal revenue service of their resident. Look at that one, state internal revenue service of their resident. Then withholding tax, where the payment is due to what? Resident of FCT Abuja. Those people that reside in Federal Capital Territory Abuja, they are payable to what? FCT IRS, Federal Capital. There is an internal revenue service for Federal Capital Territory. They call it FCT IRS, which is what? A body under what? Under the Federal Inland Revenue Service. Then for withholding tax deducted from payment made to members of the armed forces, members of the Nigeria Police, all other forces, and what? Members of the Foreign Affairs Services are payable to Federal Inland Revenue Service. Then for what? Withholding tax due to non-residents, whether non-resident company or individual. Once it's a non-resident, it will be payable to Federal Inland Revenue Service. So that will is payable to, and what are the various withholding tax rates that are payable. Then after knowing the where to pay the withholding tax, what are those income and transactions that are subject to withholding tax and their rate? Before now, we have a standard rate that is usually applicable to for both resident and non-resident. It is usually a uniform one rate. But now, the new withholding tax regulation, which I said came up in the regulation 2024, has remodified the rate now. There's the rate, some of the rates for residents differs for non-residents. Please, this rate will not be provided by the examiner. It is expected that we know this rate for each of the transaction or income. Please, let us be let us familiarize ourselves with the various rates that are applicable for the withholding tax. Then the rate. So we have the transactions. We have for company, we have resident company and non-resident. We have individual, resident, individual, and non-resident. Where the transaction is dividend and interest, we have all the taxpayer. We have it is at the rate of 10%, which is also the same with what we have what you have initially. We have for royalty, we have 10% and 5% for individual, whether resident or non-resident. Rent, hire of equipment, hire of motor vehicle, any form of hire or lease payment. It is what 10% throughout for all category of taxpayer. Please, this hire of motor vehicle that I mentioned, it is not when you order Uber. Please don't go and order Uber and say, your lecturer mentioned to you that when you hire a motor vehicle, you are supposed to deduct. So it is not that. This hire of motor vehicles, there are some companies that their own activities to provide a fleet of cars. That is their major activity. They provide fleet of cars as well. Logistics, that is what they do. So when you hire from them, so you are expected to deduct or withholding tax. Then we have a commission, consultancy, technical, management, and professional fee, like our audit fees and so on. Then for company, resident 5%, non-resident 10%, individual resident 5%, individual non-resident 10%. So let us take note of that. So before now, it's usually be 5% for individual and 10% for company. It has been remodified now. Supply of goods or material other than by the manufacturer or producer. Maybe you are a middleman, so you are not the producer of that goods. So if you are the middleman, so when you are selling that goods, the person that is going to buy that goods is expected to charge your withholding tax. So it's only applicable to resident, company, and individual. Before now, the rate it was initially 5%. It has now been reduced to 2%. Then we have collation and telecommunication services, all form of telecommunication services. So all form of telecommunication towards services. So maybe you want to construct mask or all those services that are available under telecommunication. We have 2% for resident company, 5% for non-resident, whether company or individual. Then we have a supply or rendering of services. So when you render services, 2% for resident company, 2% for resident individual, and 5%. Before now, everything happened was initially 5%. Non-resident has now become 5%, while resident is now 2%. Construction of road, bridges, building, and power plants. This category of 4 construction, 2% for resident and 5% for non-resident. Before now, it was initially 2.5%. Any other form of construction and related activity to be 5 and 10%. Brokerage fee, 510, 510. Director's fee, I mentioned it earlier because director of the company must be what? Individual. It is either you are resident or non-resident. For resident is 15% and for non-resident is 20%. It was initially at 10%. It has now been increased to 15 and 20%. Compensation for loss of office, 10% for individual. Entertainment and sport person. Government find out that majority of these foreigners, they just come to Nigeria. They come and sing, musician or all those sports people. They come and collect money and then run away with those money. And government, they find it that they don't want, so they also want to make money from those activities. So they now you can see that one is related to only the non-resident. For non-resident company, 15%, and for resident individual, 15%. Then winning from lottery, gaming, reality show, that is related to individual, 5% for in resident and 15% for non-resident. So those are the transactions. So when you see any of these transactions, you are supposed to charge the applicable rates. As I mentioned earlier, these rates are not going to be provided by the examiner. So you are expected to know this rate. Please let us try and familiarize ourselves with the rates. And for each of these, so the law gave power to the Minister of Finance to add to anything that they feel that it can be included in this rate. The Minister of Finance have a right to add to it and also to increase the rate from time to time as the rate require. So then what are those? As we have transactions that are liable, what are some of the transactions that are that are exempted from withholding tax. Some of them across the counter transaction. That is what transaction that you bought on what cash and carry. So you went to the market instead of asking somebody to supply you. You went to the market yourself. You pay what through any means, whether through cash or through transfer. So nobody supply you. You are the one that went to the market to go and buy those items by yourself. That is why across the counter, it will not attract or any withholding tax. Goods manufactured or material produced by the person making the supply. So you are the manufacturer of the goods. So when we did this rate here, I mentioned some supply of goods or material other than by the producer. So, but where you are the producer, it will be exempted from withholding tax. Then imported goods, where the transaction does not create a taxable presence. So, where you are importing an item, but that item you are importing, that item is what is a non-taxable item, or that person that is importing that item is not liable to tax in Nigeria. Maybe as a result of exemption or as a result of other activity, that particular it will be what? It will not be liable to what? To withholding tax. The interest and fee paid to a Nigeria bank by way of direct debit of the fund which are domiciled in the bank. Maybe you have an account in one or two banks. You have a current account and savings account. You now decide to as a result of the transfer or as a result of providing funds in those accounts, they now pay you interest. So because it is still within the same financial institution, so it will not be it will not attract or withholding tax. Income and or profit exempted from tax. Also, out-of-pocket expenses that is normally expected to be incurred directly by the supplier and is usable from contract fee. So, expenses that you are going to use to carry out your day-to-day activity, they are not liable to withholding tax. Claim in insurance business, insurance premium. Any premium you pay, when you are paying it, no withholding tax will be charged on it. Or when they pay you claim. So, as a result of the premium you pay, no withholding tax. Supply of any of the oil and gas products, petrol, gas, any of the products, they are exempted from withholding tax. That is part of the new regulation, which has exempted petroleum product from withholding tax deduction. Any distribution or dividend payment to a real estate investment trust or real estate company provided under Section 80 of so a real estate company, any dividend they are distributing, because that dividend is also part of that real estate, that dividend, that money is also part of what they are using to do their activity. Compensating payments under a registered security lending transaction, commission retained by a broker from money collected on behalf of the principal. So a broker collected money, so he now collected commission. Commission retained for them. It's not going to be subject to any form of withholding tax. Then we also have we have a winning from game or chance or reality show with content designed exclusively to promote entrepreneurship, academic, technological, or scientific innovation. So you also not be subject to withholding tax. Please, you also need regulatory fee paid to government. Maybe you are paying money to SEC, to CBN as a bank. All those regulatory fees are not going to be subject to any form of withholding tax. Also, when you receive your salary is also not subject to withholding tax. Please, the way transactions that are liable to, so all those transactions that are also exempted, you also need to know those transactions as well. So this withholding tax now, because tax is not as a result of whether you are resident or not. Non-resident people, either individual or company, are also subject to to this withholding tax. In order to encourage non-resident to invest, because most of the transactions that will attract this withholding tax are investment income. In order to encourage them to invest in investment, to invest in Nigeria, the government now decided to reduce the withholding tax rate for some category of for some category of income. So for non-resident, in order to increase investment. Initially, we know that the withholding tax on dividend, interest, royalty, most of them, like the dividend is what? For non-resident is 20%, while the interest is 10%. So if a non-resident now invests in Nigeria, if that non-resident is a company, the withholding tax will be reduced to 7.5% instead of charging them what? That percentage of 20%. That is introduced in order to encourage what? Investment from foreigners. Where the recipient of that income is what? Is an individual. It will be reduced to 7.5% for dividend and interest and 5% for what? For royalty. So that is what is called a double taxation treaty or agreement between what? For withholding tax in order to encourage investment. As a withholding tax now, who are now those people that what? That are expected to deduct withholding tax? You and I, me and you now, that we are underpaid employment, we have power to deduct withholding tax? Because if I want to pay my landlord rent now, do I have power to say, Oga landlord, I'm not going to pay you your full amount, and you have to deduct withholding tax? Who are those that are what? That do with responsibility of deducting or withholding tax? So those that can deduct withholding tax, a body corporate, unincorporated, other than an individual. A body corporate that is, or unincorporated other than an individual. That means you and I, that we don't run business, we cannot deduct what? Withholding tax. Only what? Only company, corporate body or individual that are in what? In business can deduct what? Withholding tax. Government or government ministry or department, a statutory body, a public authority, any other institution or enterprise, including those exempted from tax. The fact that you are exempted from payment of tax, maybe you are in the free trade zone, or your government you are under our pioneer legislation, that does not mean that what? When you carry out transaction, you cannot deduct what? Withholding tax. The fact that you are exempted does not what? Exempt you from deduction. A payment agent, the rest of those mentioned above, any of these can deduct withholding tax, or any incorporated entity or individual that operates for the payee scheme. Any incorporated entity that operates the payee scheme can what? Can deduct what? Withholding tax. So in essence, so the tax law, the new tax law, the new regulation now proceeds for that. Small business making less than 25 million in annual turnover. Because we know that business are divided into three. We have a small, medium, and large. So for small company that their turnover is 25 million and below, they are exempted from what? From the deducting withholding tax. But there is a condition attached to it. Provided that that person you are dealing with is having what? Have a valid TIN number or payer ID. Where the person does not have a valid TIN number or payer ID, you are mandated to deduct and remit. And what? That supply does not exceed 2 million naira in a what? In a calendar month. That single supply that you want to supply to that person in a month is not going to be more than 2 million naira. The entire supply in that month. Where the supply to that particular person is more than 2 million naira, you are expected to deduct. But where the person does not have a valid TIN number or payer ID, you are also expected to deduct. But where the person is having a valid TIN number and the supply in a month is not up to 2 million, you cannot deduct what? Withholding tax. So in essence, that means by law, small companies are not what? Expected to what? To deduct what? Withholding tax. And by law, they can also not suffer what? Not suffer withholding tax on what? On any transaction what? That they enter into with what? Other companies. So let us take note of that. So after we have deducted now, so please, you and me, that's what? We are in paid employment. We cannot deduct what? Withholding tax. You cannot tell your landlord that, okay, you want to what? You want to remove his no money. You are not what? You are not an agent for what? For deduction of what? Of withholding tax. Then, after we have deducted, you don't just sit down and say, yes, maybe I have deducted. Let me use the money. There is a time limit for what? To remit that what? Withholding tax. Where the payment relate to what? Individual. You have within 30 days. You have within 30 days. When what? When the amount is due or the date of the payment. So we have within 30 days when the amount is due or the date of the payment, whichever is earlier, to remit to the relevant tax authority. Failure to do that, that amount will be liable to a penalty and interest. Where the payment relate to what? To companies, corporate body, you have within 21 days from when the amount is due or the date of the payment, whichever is earlier to what? To remit to the relevant tax authority. So that means for individual, you have within 30 days, and for corporate body, you have within 21 days. Please, in the exam, where the examiner asks you for what? Period for what? For remittance of what? Withholding tax. Please give him the two period. It is only where the examiner specify that what you have to, if we say, okay, period for remittance of what? Of withholding tax relating to individual. Yes, you give him the one for individual. Where he state for comp, but where he just say period for remittance of withholding tax, please give him what? Both the one for individual and the one for what? For corporate body. So let us take note of it. So where the payment is between related parties, so the deduction shall be made at the time of the payment or when the liability is recognized, whichever is higher. So let us take note of that. Amount deducted from a non-resident taxpayer shall be regarded as final tax, except where the income is liable to further tax due to taxable presence in Nigeria. Where the taxpayer is a non-resident individual in Nigeria, any withholding tax they suffer is final. Because what? Most especially, they are not going to be liable to any other tax in Nigeria. They will be liable to tax in their country of what? Resident. So the only one that will not be final is assuming that non-resident is going to constitute what? The taxable presence here in Nigeria. Yeah, but where they are not going to constitute a taxable presence, any withholding tax deducted suffered by them is what is regarded as what? The final tax. So they are going to take it to their country for the purpose of relief. So what are the offenses? For not what? For not remitting or for not payment of withholding tax. So these are new regulations, these are new introductions that are introduced by the regulation. So what the regulation states is that what? It's stated that all supplier to have what? Tax identification number. It is required that what? Where you are dealing with what? With any supplier, that supplier must have what? A tax identification number. But when you are dealing with what? With somebody, a supplier that does not have a tax identification number, the law is that what? You are going to charge 2 times what is stated in this rate. Like for instance, if you are dealing with a supplier, let's say the supplier is going to supply you, maybe is engaging what? Rendering services to you. But that person, that supplier does not have a TIN number or a payer ID. When you are going, instead of charging him, if that person is a resident individual, instead of charging him 2%, you are going to charge him 2 times that value. You are going to charge him 4%. Because what? Because he does not have what? A TIN number. So where a supplier does not have a TIN number, you are going to charge what? 2 times what? Of the standard rate. And another thing is that so where a person is required by law to deduct as such, pay to do so and has paid such an amount to what? To the recipient. So that is, you are expected to deduct as an agent.
Question,
You
sir.
know,
Question, sir.
okay, I'm with you.
My question is, he refused to provide TIN because he forgot to add it to his invoice, or we have made inquiries, asked him, and he refused to provide it. Is that when we're supposed to deduct 2 times?
No. That is not. But he asked now, even though where he refused to provide it, that is not a problem. You can get that from their company registration number or from the FRS tax programs. Once you put their information there, which is specifically, this is related to, it does not, is yet to register with the tax authority. No thing at all, or no payer ID for individual. You get that? It does not have TIN number or payer ID.
Okay.
But where you already have, but is yeah, it does maybe by default or so you cannot charge two. But this one is relating to where it does not have at all, is yet to register. You have to charge 2 times of the rate. You get that? Then another offenses is that what where you are supposed to deduct, but you now fail to deduct. So and that person that you fail to deduct is a taxpayer that have what payer ID. If you are going to what you are going to be liable to what to the administrative charges, including what interest and what and penalty. You are going to be liable to administrative penalty and what annual interest at the prevailing commercial rate. Before now, when you are supposed to deduct and you fail to deduct, when the tax authority now find out about that transaction, you are going to be liable for that payment that you refuse to deduct, and you also be liable for interest and what and penalty. But now the law has been modified. That's all. Where you are supposed to deduct, but you refuse to deduct, you are not going to be liable for that payment that you do not deduct. You are going to only be liable for what? For administrative penalty and what? Interest on what? At the prevailing commercial rate. So because what? It's of the belief that what? The tax authority will still what? Will still meet up with what? With that particular taxpayer and collect what? The appropriate what? Withholding tax on what? On that tax. So that what? It will not become what? Double payment. That is what? That is why that is what? Taken into consideration. Then any person or body corporate who have been obliged to deduct tax at source, fail to deduct, or having deducted, fail to remit such tax to the relevant stipulated time frame shall be guilty of an offence and liable to administrative penalty and annual and so shall be an administrative. So you are supposed to deduct, but either you have deducted, or after you deduct, you fail to remit. You have deducted and you fail to remit. So you are going to be liable to the payment you deduct. Also, you are going to be liable to the payment you deduct, and also you are going to be liable to an administrative penalty plus what? Interest at what? At prevailing monetary policy rate of what? Of the CBN. So those are the offenses that
I'm confused though.
Yeah, the first one is what? You are supposed to deduct, but you did not deduct. That money you did not deduct, it will not be on your head. It's only what? The administrative penalty and interest that you are going to what? Pay. They are going to charge you. This one now, you deducted, but you now refuse to what? To remit within the time limit. So you are going to be liable to the payment you deducted. You also pay administrative penalty and also pay what? Interest at what? At the prevailing commercial rate. You get that now? So that is what that information is talking about. So that is for that. Then if you deduct, so if the currency of deduction, where the transaction is done in what? In foreign currency, it is expected that what? You also deduct in what? In that foreign currency and what? And remit. But where the transaction is in foreign currency, so the mode of remittance will now, you are expected to what? To remit that transaction to what? To CBN, because we don't what? We don't deal in foreign currency. So you are going to remit what? To CBN. There is an account of CBN that is usually what? That you are going to remit it to. Then CBN they are now the one that will credit what? The appropriate Naira equivalent with what? For the what? For the relevant tax authority. So where you are doing a transaction in foreign currency, it's expected that you should not do bureau exchange for what? For the tax authority. Deduct the transaction in that foreign currency and remit it what? Accordingly in that foreign currency as well. And now you have the rate there now. The rate are here now. If assuming you are giving somebody, you are giving
no, not this rate. Like if I get an invoice in dollar currency, how do I pay?
And now you get an
Nigerian rate.
It's the same
Nigerian
rate.
Naira.
Don't it concern you with the dollar currency? You don't have business with the rate. The dollar currency, okay, you are doing a transaction the transaction is $5,000. Calculate 5% of $5,000. Any amount you have of the 5% is what you are going to remit. Nothing concern you with the rate. You are not the bureau.
Okay,
Did you
noted.
get it? Yes. So your transaction is what? Is done at $5,000. When you are calculating, let's say you are rendering services, the contract value is $5,000. When you are calculating, you calculate what? 2%. 2% of what? Of that $5,000. Any amount. So if the 2%, let's say it's $500, you are expected to what? To remit that $500. Not that what you are going to exchange it with what? Any rate. So remit the $500 to what? To the relevant tax authority. So do we get that? So that is what they are saying about that. So currency of what? Of deduction is currency of the transaction is what you are going to deduct and what? And remit to what? To the relevant tax authority. So that then there are some income that are regarded as well. Frank investment income. There are those income that so any tax suffered on them are final because what? Because most of those income will not be what? Will not be what? Disclosed by the taxpayer. So any withholding tax you suffered on them is what? Final tax. So that means the implication of that is that when you see those income, when you are computing your tax liability, you must what? Eliminate them from your computation of tax liability. And example of frank investment income is what? Dividend. And a good example is what? Dividend. So, but for non-resident, we have a dividend, interest, royalty, and but for resident, a good example is what? Is dividend. So, which is what? Which is a frank investment income.
Sorry, sir. Is it in dividend that I have earned as the company or dividend that I'm paying?
Dividend that you No. There's a difference between dividend you earn and dividend you pay. Whether you earn it or not, it is when you earn it, by the time if you earn it as a company or if you earn it as a company, you are still going to what? Record it as part of it. It's part of your income. When you want to pay tax, they are going to remove it from your where you earn it as an individual. When they are charging you to tax, if it's part of your income, they are going to remove it from your income. Because that withholding tax they deduct on it is what? It's final tax. Whether you are earning it or you are paying it is what? Frank investment. Because if you are a company, if you are paying dividend to your shareholder, by law, it is expected that you must deduct what? Withholding tax on that dividend. The law mandates that what? As a company, when you are paying dividend, you are mandated by law to what? To deduct what? Withholding tax. It is compulsory that you must deduct what? Withholding tax on what? That transaction. So that is that. Then what are now the difference between what? Withholding tax and what? Value added tax. VAT is what? It's an indirect tax, while withholding tax is what? Direct tax. VAT is imposed on goods and services. Then withholding is imposed on income at source. Then VAT has a standard rate, 7.5%. So for withholding tax, it's dependent on what? On the nature of the transaction. Then VAT is backed by what? The VAT Act. The withholding tax is backed by what? The withholding tax regulation of what? 2024. VAT is only governed and collected by FIRS, but withholding tax is collected by both the state and what? Federal Inland Revenue Service. After they collect VAT, it's going to be shared among the 3 tiers of government. But for withholding tax, no share. Anything you collect as a state belongs to you. Anything they collect by federal belongs to what? To federal government. So that is what? That is for withholding tax and VAT. So me as an agent now, I have deducted withholding tax from a particular vendor. How do I account for that withholding tax? So that accounting for withholding tax is what is called a filing of what? Withholding tax. That account for withholding tax, you are going to file for withholding tax using what is called what? Withholding tax schedule. So that schedule is where you are going to state what? Information relating to what? To withholding tax. So withholding tax schedule is simply what? A document prepared by what? By the agent to what? To the relevant tax authority, showing what? Showing the details of what? Of the withholding tax. It's going to be prepared by that person who deducted the withholding tax, and you are going to what? Present it to what? To the relevant tax authority. Usually, it is usually presented to what? To the bank by the time you want to make it. So when you are now doing the filing, you are going to present that schedule, including what? Including the bank drafts for what? to make payment to what? For the withholding tax. Where it is to federal government, the boundary will be written in federal government. Where it is to state, it will be written in business. And you may be asked for the content of this withholding tax schedule. Please, you don't need to crack your brain. You know that somebody must suffer that tax. So it's going to have what? The name of the person, name of the taxpayer who suffered, 18 number or payer ID. There's going to the transaction that you are going to charge the withholding tax on. There's going to be a transaction that you carry out, that the gross amount of the transaction, the nature of the transaction, the rates that you are applying, the check number, date of the payment, all those information are content of what? Withholding tax what? Schedule that will be prepared by what? By the agent. After you prepare the schedule, you present it to what? To the relevant tax authority through the bank. The relevant tax authority is also obliged by law to what? To give you something that, yes, we have collected this money from you on behalf of what? On behalf of this so person. That document that will be provided is what is called withholding tax credit note. That credit note is now what you are going to use to what? To claim your tax liability. So the withholding tax credit is a document that is what? That is issued by what? By the relevant tax authority, showing what? Showing from the agent on behalf of the third party. So that third party now, this going to what? To the relevant tax authority whenever you want tax liability. Please let us take note of it. So, and let us take note of this. So where the beneficiary has no TIN. So where you are dealing with a beneficiary that has no TIN, you are going to use what? Their NIN number to what? To quote for the what? For the withholding tax. And where it is an individual, so where it is an individual, where the beneficiary does not have a TIN, has no TIN number. TIN number is related to company. In the case of individual, you are going to use what? NIN, while in the NIN, national identity number, while in the case of what? While in the case of company, you are going to use what? Their RC number as what? As the number that you are going to use to what? To quote the transaction. And don't forget, I mentioned it earlier, where you are dealing with what? A supplier that does not have what? A TIN number or payer ID, you are going to charge what? Twice the rate stated in the tax law. So where a person issue a receipt to the relevant tax, the beneficiary shall, yes, this is also part of the new activity. Where for now, somebody has deducted my money. That person that deducted my money is yet to remit it. Because he's yet to remit it, that means I will be unable to get what? A credit note. So what the law says is that what? That does not stop me from where? From claiming what? The withholding tax credit. Because what? Somebody has already remitted. So what will now happen is that what? That person that's now deducted and failed to remit is going to be liable to what? To that amount, and also what? And a penalty and what? An administrative penalty and interest and yeah. So that means where you deduct and you did not remit. So before, if you did not remit, that means the person will not have the avenue to what? To claim the withholding tax. But now, where you deduct, but you are yet to remit, the person will still be what? Entitled to what? To that withholding tax credit note. But it is only what? By the time they now want to collect it from you, you are going to be liable to what? To administrative penalty and what? And interest at what? At the prevailing rate. Then you may also be asked for the content of what? Of the credit note. It's also very simple. It's going to have a number. The name will also be there. Name of the taxpayer, name of the beneficiary, name of the person who deducted, name of the person who is benefiting, the nature of the transaction, the name of the tax authority will also be there. So the bank where you are making the payment, all those activities will also be in the withholding tax or credit note. disadvantage. Please, last diet, this was tested. They asked for what the disadvantages of the withholding tax. So please, it's very important. So let us also go over them. It enhance voluntary compliance. So you don't need to work. You don't need to be running after you. So it is voluntary. So they are going to cash you. As they are paying you, they are deducting it. It creates more awareness on taxation. So you'll be able to know that, okay, I'm supposed to pay tax. It reduces the incidence of tax evasion. So you will not be able to evade tax. It helps to bring unknown taxpayer into the tax net, yeah, to make tax payment less cumbersome to the taxpayer who may not bother going to the tax office to pay his tax. It helps to bring obscure transactions into tax net. Some of the transactions that you may not be able to see, they are going to be brought to the tax net. It helps to strengthen the tax administrative machinery by engaging numerous, even though they are not government officially. As a result of the above, tax collection becomes, yes. You may also be asked for the disadvantages of this withholding tax, which are the high rate of withholding tax is likely to affect the operational performance of most business because of the rate. So some of those rates are as high as what? 15%, 20%. They affect what? Business. The application of withholding tax affect the cash flow. So some of the money that you are supposed to be using, so they will have deducted it as source. It is likely to discourage hard work by revenue officers since it is self-accounting in nature. Yeah, it leads to locking up of capital of some businesses with the revenue agency. So they are going to collect it in advance. Bureaucracy in the process of claiming withholding tax credit. So to claim it is not that easy. So thank God for some of the technology that has been introduced, that are now being introduced by the tax authority, like the tax promas and some other technology, which has made it easier for the taxpayer to be able to claim the withholding tax credit. Appropriate withholding tax rate to apply to transaction. In some cases, tax agents are in dilemma to determine and apply. So some of these rates are not some taxpayer, they don't know what the rate that is applicable to some of these transactions. So those are the information that you are expected to know as far as withholding tax is concerned. Any question? Any question?
The withholding tax from banks, is it a credit note to the person that's suffering the reduction?
Banks, I don't get. In what form? What do you mean by withholding tax from banks? What
Say
way?
in my bank statement now, I
Ah,
see a withholding tax deduction from, say, a GT bank.
okay.
Am I
From
going
your
to?
bank statement
Yes.
as a company.
Yes.
What is the transaction? There will be a transaction that will give rise to that withholding tax.
Yeah, I transfer
If
money to another person.
you transfer money to another person, bank
Yes.
cannot charge. Bank, if you are transferring money to another person, they don't charge withholding tax for such transaction. They can't charge you withholding tax when you are. It is when they pay you interest. Interest. What they charge you is what? Stamp duty. When you are on that money, they usually charge is either what? Stamp duty, administrative expenses. It is not withholding tax. So it is their bank charges. That is not withholding tax. For that money, it is either what they charge you bank charges or stamp duty. Bank charges is what? The money belonging to the bank for that services they are what? They are providing for you. Why that stamp duty is what? Is another tax that is what? Collected by the government. So when you are transferring money, they don't charge withholding tax. So please, it is not withholding tax. They can only charge you withholding tax when they are what? When you are receiving income. So that money they charge you when you transfer money to another, it is not withholding tax. It is what? Bank charges and what? Stamp duty. Is it clear to you?
You get it, sir.
Any other question?